For decades, the Americans' dream was pretty simple: get a decent job, save some money, buy a house, and pay off the mortgage. And eventually, don't just have a place to live, you own an asset that can build wealth over time. That was the formula. By 2026, the formula is getting lot harder to follow. Median existing home in America is now around 4,034 grand, nearly 400 grands. A 30-year mortgage is hovering around 6.7%. Existing home sales are running at only about 4.06 million annually. And the first time buyers make up just 29% of purchase. And here what makes this really interesting. Americans still want houses. The problem isn't a sudden disappearance of a demand. Problem is that the math of actually buying one has gotten brutal. The house is expensive, mortgage is expensive, the down payment is still expensive, and millions of people who already have homes have mortgages so cheap that they have very less reason to sell. So now we got a market where buyers can't comfortably afford the house. Sellers don't really want to sell them, and builders can simply create cheap new homes overnight. And once you look at the numbers, this start making a lot more sense. So let me break down exactly what's going on. First, the most obvious problem: the house itself got more expensive. Now, when people talk about housing prices, they usually say something like, "Yeah, houses went up a lot." But that's not actually the best way to measure affordability. The better question is, how expensive is a house compared to the income of the person trying to buy it? Because a 400 grand house means something very different to somebody making a 50 grand a year than it does to someone making a 50 grand a year. And over the past few decades, the relationship has gotten worse. Back in the 1990s, a typical home was roughly 3 to 4 times the median household incomes. That was expensive, but still within reach for a large part of the middle class. Today, that ratio is much closer to 5 times the income. And that's a very huge difference because your paycheck doesn't automatically go up just because the house did. According to the figure we are using here, between 2019 and 2024, median home prices rose roughly 48%, while median income increased by around only 22%. So imagine your income goes up 22%, that sounds pretty good. But then the thing you're trying to buy goes up by literally 43, 48%. You got a raise, but you still become less able to afford the asset. And that's before we even talk about the mortgage, because the price you see in Zillow is not the real cost of owning a house. You still have the down payment, the mortgage, the property taxes, and the insurance and maintenance and repairs. And then there's the interest you pay for the privilege of borrowing hundred of thousands of dollars. So the first problem is pretty simple. The house got more expensive faster than the buyer got richer. But this is where the things get even worse. Because the house doesn't just cost more, the money required to buy the house costs more too. Let's say you find a house for 4,000 grand. And let's assume you're putting down 20%. That's about $80,000. And you are borrowing roughly $347,000. Now let's compare two different buyers. First buyer gets a mortgage at 3%, and the second buyer gets a mortgage at 6.7%. The same house, same loan, same 30-year-old term. But the first buyer monthly principal and interest payment is roughly 1,464. The second buyer pays paying around 2,241. The difference of around 777 dollars every single month, and more than $9,000 a year. And now look at the interest cost. At 3%, you're paying roughly 180,000 grants interest over a life of the loan. At 6.7%, you're paying roughly $459,000. That's about $280,000 more in just interest for the exact same house, the exact same four walls, the exact same kitchen, the exact garbage garage, the exact same garage. Nothing about the house changed. The price of the money changed. That's why the mortgage rates are such a massive deal. When people say homes are expensive, they're only telling you the half story. The other half is how expensive is to finance that home. And right now, that's a very huge problem because a buyer isn't just trying to afford a 4,000 grand house. They're trying to afford a 400 grand plus decades of expensive financing. And that can be enough to completely remove an entire group of buyers from the market. But then we ran into another problem. What about the people who already bought their houses when rates were cheap? And this is where the housing market gets really weird. Imagine you bought a house in 2021. Your mortgage rate was around 3%, and now it's 2026. Do you want a bigger house? Maybe you got married, maybe you had kids, maybe you got a new job in another state. Normally, you just sell the house and move on. But now look at your mortgage. You got a 3% loan, and the house you're moving into required a mortgage closer to 6.7%. So you're effectively giving incredibly cheap money and replacing it with much more expensive money. That's the lock in effect. Honestly, golden handcuffs is probably the easiest way to think about it. You're not physically trapped in a house, you're financially trapped by your mortgage. And this matters a lot because the housing market doesn't care just depend on your buyers. It depends on sellers too. You can have millions of people who want houses, but if the people who already own house don't want to sell, the supply of homes able to those buyers stay limited, and that's exactly the problem we are seeing. Homeowners are with cheap pandemic era mortgage have a strong financial reason to stay where they are. So the chain becomes cheap mortgage, less intense incentive move, fewer homes listed, fewer choices, more competition for the houses yet to come into market, and suddenly a mortgage reach someone got a 5 year ago is affecting a house, and suddenly a mortgage reach someone got 5 years ago is affecting housing supply today, and that's the lock-in effect. And this brings us to what should be the obvious solution if existing homeowners aren't selling enough house. Then what's the love like? Is there, why don't we just build more? Well, building houses turns to be a little more complicated than ordering on Amazon. A builder needs plants, they need labor, they need materials, and they need financing. They need permits. Then depending on where they are, they may have to deal with zoning laws, other local restrictions. It makes development much harder. So think about the cost of a new house: land, plus labor, materials, financing, regulations, and all of them eventually got baked into the selling price. If those costs up, the builders have nearly two choices. First is to raise the price or accept a lower profit margin. And right now, builders are being forced to do both. In August 2026, builders' sentiment remained weak with NHB Wells Fargo index at 35. Nearly two-thirds of builders were offering incentives, and around 30% were cutting prices. With a price reduction around 6%. Think about what it means. Builder knows buyers think the house are too expensive, so they are offering mortgage rate buy downs. They are offering upgrades. They are offering incentives. They are cutting prices. But here's the problem: they can't just cut prices forever because the builders still have to pay for the land, the workers, the material, financing, the permits, the insurance, everything. So you created this weird situation where the buyer is saying, I can afford the house. And the builder is basically saying, I know, but I can build it for much less. And that's the builder paradox. The buyer wants a cheaper house. The builder wants to sell more houses. The builder also needs to make enough money to keep building. And if those numbers don't meet in the middle, the transaction doesn't happen. Which brings us to the question everybody asks: houses are unaffordable. Why haven't prices just crashed? Why isn't this another 2008? Well, here's the problem with that comparison. Today, housing market and the 2008 housing market are not the same thing. In 2008, there was a massive financial stress. There were distressed sales, there were bad loans, there were oversupply. There was millions of people who were forced to sell or default. That creates a huge amount of downward pressure on prices. Today, the problem is almost the opposite. Buyers' demand is weak, seller supply is weak too, and people who want to buy are struggling. People who want to buy are struggling with affordability. The people who owns houses are often reluctant to sell. So instead of getting lots of buyer plus lots of seller, you get fewer buyers plus fewer sellers. And when both sides get weaker at the same time, something strange happen. The number of transactions falls. The July exiting home sales were running at about 4.06 million annualized, while inventory school stood at roughly 1.54 million homes, or about 4.6 million of supply. So this doesn't look like a giant flood of house hitting the market. It looks like a market can't clear. Buyers wait, sellers wait, builders wait. Everybody is waiting for the rates to fall, prices to move, or affordability to improve. And that's why I wouldn't necessarily describe what's happening as a crash. I describe it as a freeze. And it freeze creates another problem, a generational wealth problem. Because if you already own a house, this market can actually look pretty good. You may have a low mortgage rate, you may have years of appreciations, you may have built up hundred of thousands of dollars in equity, and your housing payment may be relatively stable. Now compare that with somebody trying to buy their first home today, and they have to deal with higher prices, higher mortgage rates, a down payment, taxes, insurance, and competition from people who have much more money available. And we are seeing that in the data. First time buyers made up only 29% of existing home purchases in July. Historically, that number has been closer to 40%. And this matter because owning a home isn't just about having a place to live. For millions of Americans, a home is also a wealth building asset. You make a mortgage payment, you build equity, your property can appreciate. And over time, that become a huge part of household net worth. And now you have one group that's already inside that system, building equity, while other group is still trying to pay the entire fee. And that's how a housing affordable problem becomes a generational wealth problem. And here's what don't want to make the lazy argument is say the banks are evil, or it's all investors, or it's all the government fault. Because actual situation is more complicated. Lots of different people benefit from expensive housing. Existing homeowners benefit when the value of their homes rises, and banks and lenders earn interest from mortgages. Local government collect property taxes, and landowners benefit from higher land values. And builders can make money selling homes, and homeowners who bought years ago continue to build equity. And the interesting part is all of these incentives can make individuality can make sense individually, and homeowners doesn't want to voluntarily destroy the value of the largest asset. A bank wants to make a profitable loan. A city wants a tax revenue. A builder wants a profitable project. A landowner wants to maximize the value of their land. Nobody has to sit and nobody has to sit in a room and say, let's make a house and housing unaffordable. Sometimes you just have to have a system where everybody is doing what makes sense for themselves. The combined result is a market that's incredibly difficult for a new buyer to enter, and it brings us to one of the most common argument in a personal finance. Renting is throwing money away. No, not necessarily. Buying a house isn't automatically the better financial decision. When you buy, you're paying more than your mortgage. You're paying a property taxes, you're paying insurance, you're paying maintenance, you're paying repairs, closing costs. And there's also the opportunity of cost your own down payment. And let's make this really simple. Suppose buying a comparable house costs you nearly 3,500 grand a month, but renting the same kind of property costs you 2,500. That's $100 difference in every single month, or $12,000 a year. And now that doesn't automatically mean some renting is better. The homeowners get the equity. The house could appreciate. The renter rent could be increased, and the investment could perform badly. There are a lot of variables. But suppose you invest for $1,000 difference every month and hypothetical 8% annual return, you end up with roughly $183,000 with after 10 years. And at 10%, you have around $2,005, $205. Those are hypothetical returns, not guarantee. And house owners has its own benefits and potential returns. The point isn't that renting always win. The point is that old rule renting is throwing money away is way too simplistic. The real question is which option creates the better financial outcome for you? Answer depends on the price of the house, the rent, the mortgage rate, how long you plan to stay, the expected appreciation of the asset, your investment alternative, and your own financial situation. So now let's put some everything together. The house got more expensive. The mortgage rates made the financing more expensive. The homeowners becomes locked into an older, cheaper mortgage and then reduce the number of homes coming into the market. Builders tried to create new supply, but they faced expensive land, labor, material, financing, and regulations. Buyers struggled to afford the price. Builders started offering incentive and cutting prices, but prices didn't simply collapse because seller supply remained constant. So transaction volume fell, and the people who already own the house often end up in a completely different financial position from the people trying to buy their first house. That's the housing machine, and there's no single broken part. It's a bunch of different problems reinforcing each other. High prices hurt offered affordability. High rates make those prices even harder to finance. Cheap old mortgages discourage homeowners from selling, and low supply make it harder for the price to fall dramatically. High construction costs make it harder to build genuinely affordable houses, and first-time buyers are left standing outside the system waiting for the something to change. So no, the American dream doesn't disappear. The home ownership didn't want impossible. It simply become expensive to enter, and that's what makes this such a difficult problem, because for the people who already own homes, the system can be working pretty well. For the people trying to buy their first home, it can completely feel broken. And until something changes with supply, financing, cost, account, affordability, the American housing machine is probably going to keep running exactly the way it is. And there's a problem that isn't going away anytime soon. So in this, so do like and subscribe to the video. I have worked so hard for this. So at least give a like and subscribe to the channel.